to the 39th Annual Cornell Real Estate Conference. My name is Jen Davis, and I am one of the conference co-chairs. Today's presentation is the fourth and final segment of the conference series hosted by the Cornell Real Estate Council, also known as CREC. CREC is an alumni-led nonprofit organization that has been around for nearly 3.5 decades, serving both undergraduates and graduate students, as well as alumni and friends of Cornell, through various initiatives, including career advisory programs, regional networking events, and this Hallmark conference. I'd like to start out by thanking today's sponsors, especially our platinum sponsor, Centerbridge, whose donation has allowed us to host this conference without fees, and all of the sponsors have helped further CREC's initiatives, especially those focused on advancing the diversity of our industry through DEI programs. Next, I would like to thank my co-chairs, Lan-Hee Young and Alan Rifkin, as well as our planning committee members whose names you'll see on the screen. Amanda Redless, the Associate Director of CREC, deserves a special shout out for keeping us all organized and connected on our hours of Zoom calls throughout the planning process. And finally, I'd like to thank various Cornell entities who have helped support this conference and CREC. Those are the Center for Real Estate and Finance, the S.C. Johnson College of Business, the School of Hotel Administration, the College of Architecture, Art and Planning, and the Baker Program in Real Estate. As you can see, there are many ways to study real estate at Cornell, and CREC's mission is to connect us all and further our collective academic and professional aspirations. Now, a few housekeeping items before we get to the main event. First, this event is being recorded, and if you have any questions during the event, please submit them through the chat feature. Everyone will be in listen-only mode. And secondly, our speakers have generously offered their time and perspective today, and we want them to be able to share openly. We ask that our attendees, including any press, do not use any dialogue for attribution in any manner without express permission from the speakers. Turning to our program for the day. Earlier in the conference, we heard from CEOs of public REITs, property technology companies, and private real estate companies. And today we'll close out the Cornell Real Estate Conference with perspective from the institutional investor part of our industry. We'll first hear from the Hodes Weil team on the key findings from its 2021 Institutional Real Estate Allocations Monitor. And we will follow up with a conversation amongst 3 of the largest pension fund investors. To kick us off, I would like to introduce Doug Weil, a Cornell alum and the founder and co-managing partner of Hodes Weil, a leading real estate capital advisory firm. Over to you, Doug.
Thank you, Jen. And first, if I could say as a board member and also on behalf of the Cornell Real Estate Council, I really want to recognize Jen, Lan-Hee Young, and Alan Rifkin for all of their efforts pulling this conference together. I think our first steering committee meeting was over 6 months ago, and it's a tremendous amount of work, as well as everyone on the steering committee, but especially the 3 of you have gone above and beyond and delivered this amazing conference with great speakers and sponsorship. So thank you. And as a reminder, the Cornell Real Estate Council is a global network, essentially, of everything Cornell. So alumni in the professional industries and students. And it's very easy to join. So you can join as a member. It's free, and we've got a lot of programming. It's a great way to connect to Cornellians in the industry and also students. So we encourage you to join. So today I'm going to preview the findings of our Institutional Allocations Monitor. We have been producing this report in partnership with Cornell's Baker Program for 9 years now. And the goal of the report and what we set out to do is to establish the most comprehensive assessment of institutional allocations and objectives to real estate investments. So we're measuring target and actual allocations, sentiment in the industry, target and historical returns, the role of real estate in portfolios, and it's quite expansive. So I'll walk through some of the key findings. The report will be released next week, so this is a preview, and you can download the report off of the CREC website or off of the Hodes Weil website. Special thanks to Sunil Paul, who is a Baker student, so he's dual Baker degree and also MBA from the Johnson School, and he has been a research associate on the project. And in addition to all his schoolwork, which keeps him very busy, he's been really fantastic. And then our team at Hodis Weil: Michael, Lisa, Kelly Keith, Peyton Dandridge, and Alice Lee. So quickly on methodology. So what we're doing is we're surveying direct institutions, so sovereign wealth funds, pensions, insurance companies, and endowments and foundations, and we're doing that globally. So this year we had, I think, our most participants ever, 224 participants from 37 countries, and importantly, 1.2 trillion of invested assets in real estate. So we just completed the survey, and as I said, we'll be publishing the report next week. So the key findings, the key takeaway is that institutions today are significantly underinvested in real estate relative to their target allocations, and that's driving capital into the industry, driving transaction volumes, and creating a lot of momentum in the industry. So over the past few years, target allocation growth year over year has moderated, but what we're also measuring this year and seeing is that institutions anticipate increasing their allocations at an accelerated rate over the next 12 to 18 months. As I mentioned, institutions are significantly underinvested, actually at a 7-year high, and they're trying to catch up to their target allocations. So we're seeing a lot of capital flow into the industry. Portfolio returns were down in 2020, not surprisingly, but we've seen already a bounce back in 2021. So we'll talk about that for a moment. Sentiment is at a 9-year high. So despite all the uncertainty surrounding COVID and the economy, investors are feeling pretty good about real estate from a fundamental standpoint, and they're again investing more capital in the industry. The capital is weighting towards higher return strategies, which I'll talk about. So value add and opportunistic strategies, in particular institutions out of the US. And it's always been a global market, but what we're seeing is increase in cross-border capital flows. So I'll talk about why we think that's happening. And then finally, a moment on ESG, because that's part of our survey as well. So the key data point in our survey is target allocations. So institutions this year increased their target by 10 basis points from 10.6 to 10.7. So this represents the percent of their portfolio that they are targeting for investment in real estate. 10 basis points doesn't sound like a lot, but against an asset base of as much as, or maybe in excess of 100 trillion, that's a pretty big number. So that the weight of that capital, again, is driving transaction volumes and supporting valuations in the market. And importantly, over the next 12 months, institutions expect to increase their target by 30 basis points, which would be a pretty big jump. So that's what we're anticipating for next year. So current allocations, we're measuring where portfolios sit on an actual invested basis relative to target. And what we found in this year's report is that institutions are 140 basis points underinvested relative to their target. And that's the widest that we have seen that gap since we've been doing this survey. And again, this is contributing to a push of capital into the market. Part of this is driven by the denominator effect. So as public equities and alternatives, including private equity and venture, perform really well, the pie has grown, and the amount invested in real estate as a percent of the overall allocation has gone down. And so that's part of the gap. In addition, institutions were a little bit absent from the market following COVID. It took them really to the fall of 2020 to come back to the market and start deploying capital again. So the combination of these two trends are what's resulting or causing this kind of gap out in the underinvestment. So we also focus on institutional portfolio returns. What we're trying to capture is the return for an institution's entire real estate portfolio. That could include direct investments, investments in closed and open-end funds. It could include lending. It could include public equities, including REITs. So whatever the institution defines as their real estate allocation is what we're trying to capture. And not surprisingly, in 2020, returns dropped down. So on average, institutions delivered a total return of about 5.9%. That compares to what their long-term target return for their allocation is, which is 8.2%. So it was really the first time we've seen over the past 9 years that returns actually lagged their target. But again, in 2021, we're seeing a real bounce back, and we expect that it'll be an up year for returns. Conviction, so we're measuring market sentiment. We ask institutions how they feel about the opportunity to invest in real estate today from a risk return standpoint, 1 being the most pessimistic, 10 being the most optimistic. And what's very interesting this year is that for, I think, the 5th straight year, sentiment has gone up, and it's now at an all-time high, or at least as long as we've been measuring conviction, at an index, again, from 1 to 10 at an average of 6.5%. So not overly optimistic, but moderately optimistic, which is interesting at this point in the market. Risk preferences, so we're asking institutions how they expect to invest their capital from core to value add to opportunistic. And what we're finding right now in the market is that institutions are leaning towards higher return strategies. So value add and opportunistic are the preference in the market. And this is really being led out of the US, or more broadly the Americas, where institutions are looking for high returns right now. They're focused on distress and other kind of macro-driven themes and trying to get an outsized return out of their portfolios. Geographic preference, again, it's increasingly a global market in terms of the flow of capital, the investment into funds and other investment products. And what we're seeing this year is that institutions are increasing their appetite to go cross-border or to other regions. So in particular, if you look at the Americas, about 2/3 of institutions that are domiciled in the US or Canada are looking at investing outside of North America. And if you look at Asia Pacific, 95% of institutions report that they're actively deploying capital outside of Asia. And this is a bit of a change from last year when we were seeing kind of a home region bias, a little bit due to the risk post-COVID. Institutions were investing more in their backyard. They're back to deploying money on a global basis. And then finally, ESG, environmental, social, and governance. This has been an important topic for the industry, and institutions are playing a big part in this. So what we are seeing is that 50% of institutions today have a formal ESG policy. So as part of their mandate, they have adopted a policy. And then when you look at whether that policy actually has impact on their investment decisions, about 1 in 2 institutions are saying that their policy is actually impacting or influencing their investment decisions. So we're seeing real momentum in the market. Europe and Australia continue to lead the world in terms of ESG. And unfortunately, the US and Canada are at the back of the line, but picking up their intensity in terms of focus on ESG. But again, overall, the industry is very focused on ESG, and we're seeing continued growth year over year. So that's a preview of the report. Again, it'll be out next week. And with that, I'd like to turn it back to Jen Davis, who will take it from here. And it's a great panel. I'm sure you'll enjoy it. Thank you.
Thanks, Doug. I look forward to hearing our panelists' reflections after hearing that report and that update. Before we get there, I would like to introduce our moderator, Lan-Hee Young. She's also one of the co-chairs of our conference. Lan-Hee is a founding partner of Sage Hall, a firm that she co-founded with a fellow Cornell alum. She has, in her prior roles, served as the head of investor relations and capital raising for several prominent real estate private equity firms. So I cannot think of a better person to moderate this discussion with our panelists. So I'll turn it over to you, Lan-Hee, to introduce our group here.
Thank you, Jen. I'm really just excited about our panel today because we have a group of power women, and everyone is also a close confidant and friend of mine in the industry, so including Jen. So it's really great to have everyone on today. The first person I'll introduce is Sarah Geiger. She's a portfolio manager with the state of Florida, and they manage, their AUM is just under $200 billion. Jennifer Wenzel is a director at Texas Teachers Retirement System, and with an AUM of $200 billion. And last but not least, Natalie Hong is an investment officer at the United Nations Pension Fund, and they are managing $100 billion. So these three amazing women are representing about $500 billion of pension assets, investing into all different types of investments all around the world. Natalie also happens to be a Cornellian, and she's a hotelier as well, and as well as me, and also Jen and Doug on the line. So with these three esteemed women, it's really interesting just to hear a little bit more about pension funds, because a lot of times people don't really know what they're doing, and they're really investing on behalf of several million beneficiaries, including the state employees of Florida, the teachers in Texas, and all the UN employees, supporting beneficiaries in over 190 countries. So let's get started. I think we'll start with Sarah. How did you get into real estate, and what is your role?
Hi, everyone. I am very happy to be a participant in this session. I'm grateful for the opportunity to speak to you all. I actually joined the State Board almost 20 years ago. I came in as an analyst, and interestingly, real estate was not my focus at that time. I really just wanted to get in with the State Board because I knew they were a major investment firm, and I just wanted to get in the door. As I got in as an analyst, I had different roles. I did different types of work within the portfolio. Over time, I was promoted to a portfolio manager, where I oversaw some programmatic joint ventures in retail, senior housing, a little bit of agriculture. And then a few years later, I became a portfolio manager that focused on commingled funds and also overseeing some REIT separate accounts. So I've had a long tenure here, and I've worked on a lot of different interesting projects. I cover core, value add, opportunistic. I cover global funds that invest globally, domestic. My specialty region is Asia, and then also funds that cover Europe. So I get a little bit of everything.
Great. Jennifer, how about you?
Hi, everyone. Jennifer Wenzel with the Teacher Retirement System of Texas. I have been at TRS almost 13 years. Prior to that, I'm based here in Austin and went to the University of Texas, and then worked at Crow Holdings in Dallas, and then another group called Cherokee Investment Partners. But unlike Sarah, I've been in real estate pretty much the whole time whenever I ended up at TRS. And how I originally got into it was just through UT kind of on-campus opportunities that came up for internships, interning at a office tenant rep broker, a retail grocery anchored developer, and also at a bank in the real estate finance portion of a bank. So kind of had a meandering path in the real estate industry, and ended up sticking with the finance investing side, and have been at TRS, like I said, 13 years. And we cover all property types. We're mainly organized by relationship. And so I've worked on, multifamily, industrial, several different property types, and across risk profiles as well. So.
Great. And Natalie?
Hi, everyone. I'm Natalie Hong. I'm a portfolio manager and investment officer at the UN. My boss and I co-manage the $6 billion global real estate portfolio across geographies and sectors. So we invest across all parts of the risk spectrum, and in the US, Europe, and Asia. I guess I started my career actually when I graduated in 2007 at Lehman Brothers. I joined Lehman in their investment banking division. I sort of just got pulled into the banking program, but eventually, because of my background coming from the hotel school and specializing in real estate finance at the hotel school, I got pulled into real estate banking and real estate private equity eventually. Not long after I started, though, the global financial crisis hit, and Lehman was one of the first few companies to take a hit. So it was an interesting turning point at the very early stage of my career. I got to see a lot of distressed deals and special situations, which sort of, I think, looking back, shaped my perspectives as an investor. It's very rare to start your career by putting your hands on the deals that went wrong. So since then, I got a JD MBA at Northwestern and worked at Tishman Speyer. I learned how the developers worked and operators make money. But eventually, because of how I started, I think I was always passionate about being an investor in real estate, a long-term investor, and I joined KIC from Tishman Speyer to become an LP investor, where I was in charge of the U.S. co-investment program. And then shortly after, I joined the United Nations Joint Stock Pension Fund to become a portfolio manager for the global portfolio, real estate portfolio.
Thank you. So interesting how we all kind of come from different backgrounds, but we all ended up in the real estate industry. And I'm similar to Jennifer and Natalie. All I've ever done is I've always been in real estate. So, it just kept getting more interesting every time and every different job and every deal. And so, and with that said, I think I would love to just follow up on some of Doug's reflections on what's happening in your world. How do you agree with that the allocations are increasing and that you're under allocated to real estate? And what kind of returns are you targeting? We can start with Sarah since she's unmuted.
Okay. Sure. So yeah, I definitely agree with a lot of the findings of the survey. As long-term investors, we tend to set our target allocations with a 30-year view. So we have not changed our allocation targets in the last few years, actually. We operate within a broad range. We can go as high as 16%, and we can go as low as 4%. Currently, we're pegged at 10, and depending on the year and our values in the market, we've hovered around that up or down a little bit. Currently, we're 120 basis points down. So we're allocated at 8.8%. The closest we got to our actual 10% target was in first quarter 20, where we were at 10.2%. So for us, it's important to kind of stick to our long-term strategy, and we just continue to invest as much as we can with good opportunities to increase our allocation organically.
Sure, I'll go next. Yeah, so I think it's interesting what Natalie had said about, when you get into the real estate market is always interesting as well. I started out of college in 2004, and it was kind of, the ride up to the GFC, and then started at TRS during the GFC. So since I've been at TRS, our allocation has gone from 3% when it started to now 15%. And our team has grown from 7 or 8 to now almost 20. And so, we've been increasing our allocation to real estate over the last decade plus pretty consistently. I think we're probably maintaining at 15. I don't see it increasing more than that anytime soon. But, as Doug's pointed out, it is a moving target depending on where the equity markets are. And, we have created this very sophisticated capital planning model that's supposed to help us try and always be at our allocation, which is, basically impossible to be at it 100% of the time. Right now, we thought we were going to, potentially be at it, but with the run up in stock market, we still are under allocated currently. And so we're trying to hit a moving target, but feel like we're getting to a more stabilized point in our portfolio, and a little less of the growth mode than we have been in the decade past.
We're also increasing our alternatives allocation, specifically in private markets, including real estate. It's pretty consistent with the other speakers, that our net target would be around 8%, give or take. Depending on strategy, we'll add a little depending on the risk we're taking. That's associated with the region and the specific manager and the particular strategy that's associated. But I would say net 8 would be the benchmark.
Okay, well, with so much capital that you all are looking to put into real estate, and to me, it feels like everyone is chasing the same type of opportunities: multifamily, life sciences, industrial, all those niche sectors. Where are you finding these opportunities to put capital out? And, in this low interest rate world, how are you able to get to your 8% returns?
So I can start. So we're investing globally. We're looking for the best risk reward opportunities in the US, Europe, and Asia. I think that helps us because it gives us a bigger playground to play in. We are focused in the US on sectors and strategies with our fund manager that really center on demand from secular trends, demographic trends, not so much GDP driven. In Asia, we're really focused on industrial, where we feel there's an undersupply and a lot of demand for e-commerce, which is really growing everywhere globally, but it's there's a very low penetration rate in Asia in general. So that's two moving forces that make it a very attractive sector to us. We're also looking for sectors or strategies that focus on the alternatives. One idea that you may not be as familiar with is active adult. We have a manager who focuses on age restricted. It's 55 plus, but the average age is more like 75 for multifamily. These are tenants that are fixed income, usually pensions. So that makes them very stable cash flow. We don't have to worry about them maybe becoming unemployed and not being able to make their monthly rent payments. And then they're very sticky also. So it's niche strategies, unique ideas like that. They're really driven more by demographic demand.
I can't believe age restricted starts at 55.
I know.
That scares me.
I thought 55 was the new 25, right?
Yeah.
Let's make it that way.
Okay. How about you, Jennifer?
It's hard. I mean, everyone is kind of focusing on the same sectors. I think for us, we're trying to beat our benchmark, which is Odyssey plus 125. So unlike a lot of our peers, we actually have only a 40% allocation to core and the rest is non-core. So some of it's just by targeting, higher returning strategies or, able to put more leverage to get there. But we also have 20 to 25% outside the U.S., to target opportunities there, as Sarah mentioned. And then, I think just trying to use our size where we can and thinking, longer term as well. We've done quite a few either programmatic JVs or just trying to get exclusivity over pipelines in a more direct way is something that we focused on with operators. And so that's also been a focus.
I remember when the financial crisis broke out, I came to see you and you guys were putting so much capital into industrial, which seemed at the time a new asset class, and you did very well with that at the time, and then establish all these strategic partnerships. Are you doing kind of similar with very big names? But I remember there were $1 billion given to 3 different groups at the time.
Yeah, we still have we have kind of a barbell approach with some larger strategic partnerships with PE funds, and then also some global strategic partnerships to kind of take advantage of relationships on a global scale. But then we also have a lot of smaller, more direct relationships with operators and things like that. So I would say it's a pretty good, healthy mix. And, we've tried to be meaningful to the partners, in different ways for, what works for them and what works for us. So.
I have to say, just sitting, where we are today in New York, where there was just a bit of a fallout in the market, I think it's just interesting also just to think about, and I'm going to target Natalie because she's also sitting in New York right now. So how do you think about markets like New York? I'm biased because the strategy of our fund is investing in New York City and the surrounding areas. So how do you look at investing in New York and these types of major cities versus some of the new secondary cities, like where Jennifer is sitting in Austin?
So I can't speak for the UN as a firm because it's against their policy, but as a real estate investor, I'm happy to share my personal views. One of the biggest main drivers of the US economy is tech. And what drives the tech industry, if you think about it, it's talent. And I do feel that New York is one of the cities that attract the best talent, and that is really the driver of New York currently. And we're very positive about New York multifamily and selectively well-located, high quality office for the same reason. If you think about the way New York City just rebounded after COVID, after the city just shut down during COVID-19, it's a nice indicator of how strong the fundamentals are in terms of demand and the people flow. There are millions of square feet leased by large tech companies, in the middle of COVID, and I think that's a very positive sign.
I love hearing that. So I first went to go see Sarah down in Florida. I think it was 2012-ish, and then you ended up becoming an investor with us for a decade, pretty much. Yes. And so, just having grown with a firm like Starwood, how do you identify those successful managers? What is the differentiator other than track record when you're looking for these types of managers?
Sure. So we've worked with a lot of fund managers like Starwood that have been with us for a long time. And I think that one of the things that really has separated the best performers is that they're innovative in the way that they implement their strategy. They might be looking to add value, or maybe they're looking to expand their core holdings. But the way that they do it is by focusing on new sectors where the demand is coming, where the demographics support the demand for that type of property. We have seen managers that have gotten a little behind in seeing how those sectors were growing, and maybe stuck with some sectors a little longer than they should have. And I think that really limited their growth potential. And we saw that come out in their returns. Another example is with their thoughts on leverage and wanting to keep their leverage really low, even though there was opportunity to add leverage because it's so accretive at really low rates. And so that's what I would say we've noticed is that there's managers who are on the forefront in their strategies and their sector selections, and also in their geographies. We've seen managers expand, from the U.S. to Asia, and really do a good job with that.
Yeah, just going back to the previous one about the markets too. I mean, I am here in Austin, and it's been interesting to see that rotation. But I think we still are believers in the cities coming back. but like on multifamily specifically, the REITs were driven to the coast. But now you're seeing like EQR just brought a deal here in Austin, and our office rents and values are higher than they've ever been, and reaching gateway status almost. I mean, I think like $800 a foot for Austin office, and $70 rents. And so it's definitely changed.
Levels.
Yeah, it used to be a case for being a cheap alternative, and that's just not the case anymore. So, how does that change once we get expensive? I think it's something that we have to think about. And then, successful managers. I think that Sarah probably highlighted all of the right things there. We we have what we call our premier list, and we meet twice a year to review it, and we don't have a lot of movement, but the ones that are the obvious removals are first for performance, but also transparency is super important, and just how they do business, and succession planning has become a big topic as well. So it's about strategy and picking the right themes, but it's also about how you run your business and how you interact with investors as well. So.
I'm glad to hear that.
Lanhi, if I could add a comment, talking about New York and secondary markets or secondary cities, I think that when you look at this, you might want to consider that in any given city, there's a micro market opportunity in some sector. So I don't think that we can write off New York or any other city for that matter without really thinking first, well, what sector is undersupplied there, or what's in demand there? Because there's probably going to be an opportunity.
I completely agree. I mean, I think, for example, some families have moved out to the suburbs, and they are grocery shopping a lot. So, in the past, you didn't see much growth in the NOI of these grocery anchored shopping centers, but now you've really seen major growth, and for the first time in a really long time, there's a lot to do. So switching gears a little bit, I'd love to just hear about, growing up in the real estate industry, and we're all women, and was there anyone influential in your life as a mentor or sponsor? I have to say I've had a few mentors and sponsors myself, but never did I really have a female that I could call and ask them about, when I first had babies and coming back to work. And for me, it was really my mother and my sister-in-law who helped me through those moments. I'd love to hear from each of you on your experiences.
Okay, so I'll go first again. So I have to give you props, Lanhi. You were my first female friend in the industry and a solid sponsor throughout my entire career, and really inspired me and motivated me to challenge myself. And I'm so grateful for that. And that's not, interestingly, you may find in the future students that that's not always a given, that the women in your immediate space are the ones that are going to inspire you. So I would just encourage you to talk to as many women as you can, and constantly look for that smile that encourages you, that can be your mentor, because you will want someone in the industry who gets being a working mother and also being a professional and trying to keep it all together. So yeah, just keep an eye out for that. I've been here, like I said before, almost 20 years, and I have not always had a fantastic sponsor, but in the last 5 years, there's a colleague that joined, he's my immediate supervisor, and he has really become my champion. And so something else I'd want to encourage the students is to look for a champion, someone who will give you a chance, will give you an opportunity, who will believe in you, who you can ask those elementary type of questions to. Those are really important. If you don't know, you need to ask. But you also need to feel safe to ask that person. So look for these relationships, keep an open eye on them, and talk to everyone, because you never know who you're going to find to fill those shoes.
I'm so honored that you said that about me. I did not know that I was filling that role, so it's a surprise. And I'm honored by it, but also I have to say it was very easy because I didn't even know I was doing it.
Well, that's a good
I think to your point,
you know.
And I think to your point, a lot of these mentorship, sponsorship opportunities come up when you don't even know they're being formed. So I'm very fortunate to have a group of female mentors at work. And if I think about how they all started, I don't think there was any official, can you be my mentor type of thing. One colleague leads the private equity group at the UN, and because we work together, our teams work together so often, and she's also raised 2 kids of her own, there are subtle things that she gets and only a working mother would get. So for example, there was one time I pulled several all-nighters to present some deals at the investment committee while raising, I have 3 kids for sake of background, and they're all under 6. So that was way back when they were all under 5. After the investment committee presentation, and this was in front of 30 people, she publicly acknowledges the fact that, by the way, Natalie is also raising 3 kids, and it's very hard. So let's all acknowledge that. And I think that really meant a lot to me. So these are little things that are not necessarily monetary or any sort of tangible rewards, but just the concept that somebody really gets it and supports you. And I think that really builds loyalty to the firm and the organization.
Yeah, I'll go. I was lucky to have started out with some good mentors. The office tenant rep broker that I worked for in college. If you're familiar with anyone in that space, you have to be a really good negotiator. And it was, she had been in that role for 20 or 30 years, and then had started her own company, and just seeing her, how she approached her clients in the business, and seeing someone be a strong negotiator as a woman in the male industry of real estate, who'd come up through what was a much harder time even for women in real estate, was just a good standard to set. And then at Crow Holdings, Anne Raymond was a senior leader there at the time, and a lot of the associates who were in the acquisitions and asset management roles were women for that initial stage of my career, and kind of seeing how they balanced everything was great. And then, just gotten to know a lot of other really great mentors like Lanhi through the years. As Sarah mentioned, she's a great sounding board and has always been very open and transparent. And, I appreciate whenever people can, be real about how they approach, being the work-life balance and everything like that. And Jen Davis and I have had conversations, and I think that would be my advice, if we're also giving advice as part of this, is just make sure that you are being transparent and open about things, because I think that's how people share and learn. And with men as well, I mean, a lot of times we only ask the females about their work-life balance, but the men have families a lot of times, not always, that they're proud of as well. And so, making sure that they're part of the conversation, that it's not just, how's your golf game, that you can also get to know people through that side of it, both male and female. So.
I agree. I do think it's hard to find someone that can be it's rare to find a sounding board necessarily at your workplace. For me, it's tended to be somebody outside, and I think that's something to always be just on the lookout for. There'll be somebody that you just feel like I can ask the dumb questions and not feel worried about getting judged, that you can really be more open with. I mean, I feel like I've been open with many of you because I trust you and I want to hear your opinions. And it's not necessarily something easy to find all the time. So it's good when you can go elsewhere and be at conferences or even these types of events where you get to know each other. So my last question is about, I was recently on a panel and one of the women said, we're not even in the first inning, that we're just in pre-season practice when we were talking about women and diversity in our industry. What do you think we can each do to impact that? Or maybe you don't agree.
I think we've made a lot of progress actually in the industry. I've certainly seen an increase in female leadership in positions. I think we're moving in a great direction. And just as a follow-up to the last conversation topic, I think now businesses, companies are more supportive of the family work-life balance and of women in particular. So I think this generation has a lot to look forward to in that regards, in terms of what can we do as individuals. What I tried to do at the last real estate conference that I was at was I tried to talk to a lot of women that were my juniors. And it's funny because I am probably twice as age as a lot of them now. So that was interesting to see. But I tried to be really friendly, especially to those that I could tell had never been there before, because sometimes that makes all the difference in making someone feel comfortable.
I was at that same industry event, and some of you on the line may know that I love events, and I love kind of coming up with creative ideas. And there's this event that I started 16 years ago called the Women's Tea at the PRIA conference. And we brought in ballet dancers from New York City to do Swan Lake and another modern dance for us. And then we did a panel afterwards. So it was really, what I loved about it is seeing new people there. And yes, they're also finding their people and getting comfortable. And I always hear stories, it's now been 16 years, of people who met at the Women's Tea and they ended up working together or helping each other in some way. It's just, that's been one of my safe spaces for a very long time. And I look forward to it every year.
That is a wonderful event. It's a very positive event. And I'm so glad that you're doing that. And I make that a priority of mine actually, because I think that's really important to support that activity.
I'm really sorry I missed it this year. Yeah. I'll make sure to go next year.
There's always another year. It's every 6 months, so stay tuned.
Maybe if I can chime in a little bit on that last question. And first I'll say one thing from the prior question. Several of you on the phone have been great mentors to me. And I remember being 23 years old and going to these women's events and hearing, find a mentor. And I didn't know actually what that looked like. And I think that I've had a few observations. One is it can be a man who just believes in you and looks at you gender blind. But also I think finding people outside of your organization like Jen who can explain to me, how do you make it work? How do you hire a nanny? What are the hours? What do you pay them? What's your arrangement? What about when you have to travel for work? And work through that with someone so that maybe it doesn't make sense to bring it up internally, but you find mentors in the industry that help you problem solve the roadblocks that you hit so that you can keep going and keep building your career. But on that last question about what we can do, I think it ties in really well with the Women's Tea. And I think my answer to that question would be is just have more networking events where lenders who are women meet investors who are women who meet brokers and build that network. Not that you can't do that with men, but I think it's all about forming friendships and finding common ground and building relationships. And so the more we can do that together, the more we can help each other out. And that's certainly helped me and benefited me along the way.
Yeah, the one other thing I'd say is, I'm passionate about it in two places. One is, from the beginning, like finding them in college and helping them consider even a industry or a career in this industry. But then two, once you hit that middle career phase, where it does kind of get a lot busier in life, and trying to figure out all of the trade-offs, I think that's where we should be focusing a lot of our attention, is trying to keep those women in the industry so that they are at that next level and can be seen at that next level. And that's, there's probably a lot of ways to approach it, but I think one of the keys is not making it seem like you can do it all or that you have to figure it out on your own. And, everybody does approach it quite differently. And so I think there's a hesitancy to bring it up in the sense that you might offend somebody who's in a different position. But I think, sharing those ideas is super helpful to learn what works and what doesn't work for people. And I think, sometimes that's glossed over and people feel like they're coming at it, blind. So
it's true. The life hacks, somebody gave me an idea a few years ago because I was traveling all around the world and it's so many different time zones. So how do you talk to your kids? And they always seem to call at the wrong time and you're calling them at the wrong time. So how do you do it? And I love this, and I still use it today, even because I'm in New York a lot, where I will record myself with just like a video message, and then send it to their dad, or now they're old enough, one of them has their own phone, and then they can just check it whenever they want. So it's during any hour, whenever they feel like it. And there are so many little things like that are simple, but that can make a big difference.
I would like to add that I still see a lot of young women shying away from the real estate career in general, real estate, finance, or anything heavily quantitative. I would like to encourage them not to shy away, because if you're good, first of all, if you're interested, that means you're good at it, or there's a big chance you're good at it. Also, the rumors of, those particular jobs not being female friendly and things like that, it's really changing, as, you can see from this panel itself. And the other thing is, I echo Lanhee and Jen's point that if, in the middle of the career, if any issue comes up, I think it's good to also talk about it more and vocalize our needs. Because in the beginning, first, when I started having kids, I have to admit that I was kind of embarrassed to mention it, even that I had to go home and pump or whatever. I was afraid of the perception of being on the mommy track. But now that I found out the hard way that there are supportive colleagues and companies that are willing to support that, as long as you're good and they like you and they like what you're doing. So there is a solution out there.
Yeah, and that's my point about making it okay to talk about it, because I think there's this perception that we only podcasters ask the women about their families and their kids. If it's a male they're interviewing, they don't get asked. And so why is that, And so I think it becomes it should be commonplace that your family or your interests outside of work are, part of that, whether you're male or female, and
or single or with family.
Yeah. One of the is the kind of place, sorry to interrupt, but that you can bring so many aspects of yourself too, though, whether you're a woman or a man. But I talked about creativity. I think there are design aspects. There are, financial kind of analysis aspects. You can write, you can meet people who tend to have very colorful personalities in our industry, which is fun. You get to travel to cool places and see new concepts. And I think real estate, for me, I stayed in it so long because, as I said in the beginning, it was just, there was always something fun and new that I could focus on, and that made work not really feel like work.
Absolutely. And I'd just like to make a pitch for the pension plans in the country. I think oftentimes students may think a pension plan, why would I want to work for a state entity? But in a state pension plan, you just might have a very good opportunity to work on a lot of different things. to travel to all over the world, you might have you should just check it out. You should consider it. There's a great opportunity there.
I completely agree. It's always been kind of like my future dream job.
Really?
I've sat across this table from all of you, and just you get to interact with the smartest and most talented people in the entire industry, really because of your scale. So you're providing the capital for these businesses to even exist, right? So I didn't know that as a student. And when I first came into this industry, I was like, wow, that is such a cool job. I wish I had known.
Well, that's a good point. I think a lot of times students don't know. I certainly didn't know the opportunity in real estate, in institutional real estate at the board. I just got very lucky in that I landed there and that I love it the way that I do. So definitely explore and ask questions and do your research. There's so much information on the internet now about different types of positions in real estate in this sector. So, go for it.
I agree. I'd like to echo the same comment. I mean, it's such an interesting job. It's a truly global job because you get to see so much, and it's really impactful, meaningful work. And you don't really get that it's not easy to get at many jobs. So,
can I ask one question? This is a rogue question, but I'll throw it out there because I think it's relevant for our audience. As you all have built teams and hired people, if you could each share maybe just one or two qualities that you really look for, or advice to the younger generation, maybe it's based off of, not to be negative, but mistakes that you've seen from younger people, or things that maybe they didn't know when they were initially starting out of school.
Well, I've been interviewing a lot lately because I started a company. And so I feel like what I'm always looking for, it's sort of like somebody said this great thing to me about, I always know a good teacher within the first 5 seconds of meeting. This is a teacher who said it about another teacher. And I said, how do you know that? And it's because they love teaching. And I just think that when you're interviewing someone and they're just excited, and it doesn't even need to be necessarily just about real estate, but they're just excited about what they're doing in their lives. I think that's just so compelling and interesting, and it makes you want to learn more about them. And so I just remember when I was interviewing at Cornell, I used to talk about being a wines teaching assistant, for example, and I sometimes end up talking to someone that's interviewing me the entire time about a specific wine region or something. So it can really be anything.
Yeah, I agree with that. I heard recently a recruiter in the real estate industry say he does 45-minute interviews on purpose, and the 2/3 of it is spent not on the technical side, because you can usually tease that out pretty quickly based on a resume and deals, but he spends 2/3 of the time on the story of how they got to where they are, and then how that eventually put them in this position of what they want to do now. So, because everything you've done previously has led you in a certain path to what you want to do next, and so that thought process, I've always been a big proponent of that whenever I'm interviewing people, just understanding their thought process of why they made decisions along the way and how they chose what they chose. And then also the other advice, which, I can actually argue both sides of this, but I think it's impressive whenever we interview people who have a specific passion for a certain property type or sector of the real estate industry, because I think it's a problem in our whole world about people who are non-committal and they want to be generalists, but there's something to be said for like having, made a choice and committed to something and being really energized about that. Even if you change later.
I have to speak for just the investor role specifically, but when we interview, we really look for somebody who understands the concept of risk and return. So it's very basic. If you put money somewhere and get a 10% return, what does that really mean? And what sort of risk would you be taking? And is that the appropriate amount of risk? It's very simple, but not many people starting out come in understanding that concept. So whatever you can do to familiarize yourself with that concept would be helpful.
So I read something on TED the other day. It was a quote. I don't remember the author, but he said, "You don't hire for skills, you hire for attitude. You can always teach skills." I think attitude is really, really important when you're, submitting your resume. Make sure everything is grammatically correct. Everything looks good. It's not crammed. It's not over. What's the word I'm looking for? It's not exaggerated. Make sure and follow up with a thank you card. As archaic as that may seem, it's actually really important. It gets you another look. Follow up with a phone call. That's having a good attitude, and to Lanhee's point, being excited about this opportunity. And just to reference myself again, just because you don't think you have the exact perfect skill set for the position based on the job description, don't cut yourself some slack and go after it anyway, and hope for the best. And you never know, you just might get that call back.
Well, that's a great way to wrap up. Thank you all for spending the time with me and the rest of the CREC community. Thank you all for tuning in. And this concludes the 39th Cornell Real Estate Conference.
Thank you.